4. And first of all, let me clear, we'll just go through quick, we'll give a quick thing of this question. Okay, right? Okay, you need to do it yourself. I'll just make you understand the concept. Okay, now Collat company manufactures aluminium products. Collat company manufactures aluminium products. Aluminium products and operates in a region that has suffered natural disaster. Natural disaster like earthquake or something came in that area. Okay, simple words. On 1st November X7, this is the date. There has been an increase in operating cost as the company had to replace a regional supplier with a more costly international supplier. Now, wait, let me gather arguments. I know the requirement, that's why I'm gathering argument. Listen, just because of this disaster, now we cannot buy goods from a local supplier. He's not available. So now we have to buy from international supplier. So more freight charges and more freight cost, this will increase our operating cost. Listen, when this thing will increase your cost, look at me, when this thing will increase your cost, so automatically your profits, your future profits will be reduced. And when your future profits will be reduced, your future cash flows will be reduced. And when your future cash flows will be reduced, your value in use, VIU, value in use will be reduced, and reduction in value in use is an impairment hint. So one impairment hint I just gathered. Impairment hint I just gathered. Impairment hint I just gathered. This impairment hint. This impairment hint I just gathered. Okay. Because there is one requirement in which they will ask you, is there any need of impairment testing? Is there any need of impairment testing? So yes, we do impairment testing whenever we get the hint of impairment. So we got the first hint. Let's see, there are many hints. Now, non-current asset. As a result of natural disaster, the share price of Collat company has declined. Another impairment hint. Listen, as a significant amount of non-current asset were destroyed. Okay, now wait, including the manufacturing facility. Look at me. If you have studied IFRS, if you have studied IS 36 in F7 level or SBR level, wait, there is a theory in IS 36 of impairment hints. There are two types of hint, internal and external. Right now, I'm talking about external hints. So, you know, when your share price goes down, when your share price goes down, your market capitalization goes down. When your share price goes down, then your market capitalization, you know, what is market capitalization? Number of shares multiplied by share price. So that means the whole worth of your company goes down. Whole overall worth of your companies goes down. So this is also a hint of impairment. If you remember IS 36, believe me, let me quote you the exact word. If carrying value of net assets is greater than market capitalization, if carrying value of net assets is greater than market capitalization, this is also impairment hint. What does it mean? It means you are reporting your equity for $100,000. You are reporting your net assets and equity in the SOFP for $100,000, but your total shares are sold in market for just $70,000. Your total shares multiplied by share price are available in the market for just $70,000. That means there is something bad in your company. That means there is some bad thing in your company. So again, this is an impairment hint. This decline in share price is again impairment hint. So two hints I have given you. Now, the third hint is a significant amount of non-current assets were destroyed. So this is one more hint. Now, in addition, Collat company has suffered reputational damage. Yes, this is impairment hint. Now we know goodwill damage. Yes, nowadays when we listen this, that this entity is involved in this type of thing, low quality food, you know, people create rumors on Facebook, people create rumors on social media. So this is because sometimes your sales goes down because of these rumors. Even this is a proper reputational damage. But if we have seen because of rumors your sales goes down, And when your sales is going down, this is impairment hint. So 3-4 hints we got. We got the international, the operating cost, increase in operating cost. This is impairment hint. Decrease in share price. This is impairment hint. This disasters, the destruction of manufacturing facility. This is impairment hint. Number four, the reputational damage. This is impairment hint. These 4 points are more than enough. Yes, you need to do impairment testing. You need to do impairment testing. You need to do impairment as testing. Now wait, you did one requirement. You did one requirement of this question. Wait. Wait. Read this B part. Read this B part. Let me enlarge. Discuss B part only. Discuss any events affecting Collard company which might indicate that an impairment test ought to be conducted in accordance with IS 36, impairment of non-current assets. 3 free marks. 3 free marks. Do you understand this requirement or not? I repeat for you guys. Discuss any events affecting Collard company which might indicate that an impairment test ought to be conducted in accordance with IS 36. Yes, not one event, many events. Increase in the operating cost because of switching the supplier from local to international. Yes, copy paste. Very good. Number two. Somebody's saying, is this FR paper? This is called luck. This is called luck. You know, that's why in the last attempt, students scored 70s. Many students scored 65. Those who didn't come in the class with proper face wash, they scored in 65, 67. Listen. So the point is, number one is the increase in the operating cost. Number two, decline in share price. Number three, that disaster, the destruction of manufacturing facility. Number four, reputational damage. These 4 points are enough. You will get 3 marks. Easy. Now, one more loose ball. One more loose ball by examiner. You can hit the 6, and that's my favorite topic. I love this topic. And if you have, and that topic is basically general knowledge. Even in the examination, examiner has written no need to give any example from the question, just general discussion. Wait, read the A part. Read this. Investors need to understand a variety of factors when making an investment decision. The nature of the companies in which they are looking to invest is an important consideration. Yes. You know, be an investor, be a CFA guy for just 5 minutes, be an investor, or be an institutional investor. Institutional investors are like mutual funds, pension funds, those who invest the public money, in stock markets, in real companies. So investor needs to understand a variety of factors when making an investment decision. The nature of the companies in which they are looking, please concentrate. They are looking to invest is an important consideration, as is the need of the the need to incorporate sustainability factors into investment decisions. Yes, believe me, this came in previous attempts many times. This is present in articles. Even I have recorded a video for this of previous past papers, and I discussed this thing. Read the requirement. Bold requirement. Discuss why sustainability has become an important aspect of the investor's analysis of companies. Note, there is no requirement to refer any exhibit when answer this part A. You don't need to connect with the question. General discussion. General discussion, 4 marks. Let me tell you. Nowadays, investors, before investing in any company, they check these sustainability factors, like how much this company is beneficial for environment. Is this company creating any harm, or is this company involved in any unethical conduct, or is this company's risk is higher? So these things are considered very often nowadays, right? Giving you many examples now. First of all, because there are some investors, those who are called institutional investors. So institutional investors like mutual funds, pension funds, they invest the public money in the stock market. They invest the public money in the stock market. So they have to publish, they are themselves accountable, and they need to publish the reports that we are investing in this companies. So they need to be very ethical, and they need to be very cautious in making the investment decision plan. So before investing, they make a grid, or what we call, they make a checklist. Yes, they make a checklist that we are investing only these companies who is not involving in environmental damage, those who are not destroying the government laws, this, those who are good for the pollution. From pollution point of view, they are better. So they have a screening strategy. Yes, very good word. They have a screening strategy. They have a checklist before investment. Okay. And now wait, now giving you one example of environmental related thing. Nowadays, this electrical cars thing, the CO2 emission thing, even you guys are all ACCA students, and majority of you have studied UK tax. So remember, in the UK tax, the taxation implications are related to CO2 emission rate of that car. So obviously, just think, if a company is not environmental friendly, emitting high CO2, so their taxes will be higher. So when their taxes will be higher, automatically this is a cost for company, and when this is a cost for company, the company profits will go down. So automatically investor will run away. Same is the case with electrical cars, or we call it zero emission cars. Many countries are not even charging import duties. If in the latest budget in Pakistan, they have reduced. Giving you example of Pakistan, there are some students who are attending outside Pakistan, but let me give you example of Pakistan. In the recent budget of Pakistani government reduced the duty of electrical car from 17% to 1%. 17% to 1%. So there was a major price drop in Pakistan. Like, there was a car, you might have heard, Audi e-tron. It was around 17.5 to 18 million rupees, 17.5 to 18 million PKR rupees in Pakistan, but now it's 15 million. So there is a drop of 2.5 million. There is a drop of 2.5 million in the price. It's major for us in Pakistan. You getting? So if you are environmental friendly, you will get benefits. Same is the case. Similarly, with skin related products, you have seen Body Shop and these. They do marketing that we use only herbal products, and we don't use chemicals and like this, which is good for you. So this may be used as a marketing tool as well. Okay. One more thing. When you import certain materials, listen very carefully. When you import certain materials, and if they are hazardous or dangerous, so during shipping, I've seen this, I've done this business. During shipping, you need to pay extra insurance cost for that. So those things which are dangerous, which are not environmental friendly, they are automatically costly nowadays in this world. Automatically, they have done very extreme implications. Plus, why these things are increasing? Because the weather is also changing. In the last meeting, I think I have given you example that because of global warming, we have seen heat wave in Canada. So obviously, now, do you think Canadian government will take action? Definitely. Now they will keep study this topic, and they will put duties on those things which creates this negative temperature thing. Are you getting? Similarly, listen, it also sustainable factors are investors check sustainable factors from company to company. For some companies, they check it very carefully. And for some companies, they say, okay, that means materiality level. Materiality level of investors varies from company to company in terms of sustainability reporting. Like if I'm investing in car company, so car company has direct relationship with pollution. So now I will be very careful. I will be very careful regarding this sustainability thing. But yes, if I'm investing in any other business which is not linked, too much with the environment, so my criteria will be a little bit relaxed. Are you getting? Yes, got it. Then next thing. Yes, giving you one more example for this sustainability. I have seen this thing. There are certain businesses which are dangerous, like tire shop. Listen, like tire shop or selling tires. This is a very big business in US, because in US each and every household has 3 to 4 cars, average 3 to 4 cars. US is a game of big roads, big roads. So anything you sell it related to cars in US, you earn a lot. That's a very good business. So I have particularly studied, even I have done this business little bit related to tires. So there are many areas now in US where you don't get the permission to open a tire shop, because they say that it is very dangerous. In case of fire, these tires can catch fire extraordinarily. So when you have when your product is not environmental friendly, you are not allowed to work on many locations, even many cities or like that. Are you getting? So that's why investor hates investing in these types of products. They think that we will have sanctions. Yes, focusing on sustainability reporting might attract more green investors. Obviously, this is the perception. Even nowadays, it's a perception. Nowadays, this thing is used as a marketing tool. For sure, this thing is used as a marketing tool. So you can write many points. I have given you a lot of points. This is just 4 marks game. Okay. So if you get these type of general things, this is very good. You can write a lot. Okay. Now let's come back to the question. Now, the non-current asset of Collard company that were destroyed had a carrying amount of 250 million on 31st October X7, and the fair value of these non-current assets was 280 million based on an independent appraisal shortly before that date. Now the fair value is not relevant. Listen. Very simple. I have this asset C in my hand. I have this asset, and today it's burned. God forbid, it's burned. So it's $0 now. It's 0 rupees now. No value. So I will simply do, let us say I have recorded this for $10 in my books. So I'll simply write off this like this. Wait, P&L debit 10 and this asset credit 10. That's it. We all know this. This is called written off. This is called written off. That's it. One question. Do we need, very practical thing, new thing. Do we need to conduct any impairment test for this written off? No, it's destroyed. It has become powder. Because of this blast, or because of this natural disaster, this asset is no more. How will you do? Wait, how will you do impairment testing? We do impairment testing through recoverable amount. We do impairment testing through recoverable amount. How do we calculate recoverable amount? Value in use and fair value less cost to sell. You cannot calculate anything for this asset. Asset is no more. So no more value in use, no more fair value less cost. So it's better don't use the word impairment now. Just clean your books. Just make the entry. Just make the entry P&L debit 250 and that asset credit 250. That's it. Okay. This is for the next requirement. This is for the next requirement. Now, few technical basic. Let me use the correct word. Technical but basic. Technical basic things are coming. Listen. In addition, Collard company determined the power plant. You know, I've seen in my country as well, some big companies has power plant. They produce their electricity themselves. This is very common nowadays. Very common. This is fashion. In addition, Collard company determined that a power plant will have to be closed and decommissioned earlier than previously expected. The remaining useful life of the power plant has reduced from 25 years to 8 years. From 25 years to 8 years. Okay. Non-current assets are valued using the cost model. Non-current assets are valued using the cost model. Now, first of all, I will discuss this decommissioning liability in detail. Don't worry, I will. Let me tell you a little bit basics, very basics, O levels, A levels, basic level, F3 level discussion. You know, this is the case of changes in useful life. This is the case of changes in useful life. And yes, this is also one impairment hint. This is also one impairment hint because previously you were getting benefit for 25 years. Previously, your future cash flows were related to 25 years and now only 8 years. Now you are going to take benefit for only 8 years. So that means automatically your future cash flows will be reduced. Automatically your future cash flows will be reduced. So when your future cash flows will be reduced, your value in use will be reduced, and this is impairment hint. So this is again an impairment hint. First thing, keep it in mind. Keep it in mind. This is impairment hint. The second thing, whenever there is a changes in useful life. So now what you do, today's NBV, you divide today's net book value or carrying value with the remaining life, that is 8 years to calculate future depreciation. And yes, changes in useful life. Changes in useful life is basically changes in accounting estimate. Changes in useful life is basically changes in accounting estimate. So these things are adjusted prospectively. Okay, now wait, let me explain you. Let me try my best, because this is basic topic. Let me try my best to explain you decommissioning liability. Sometime we call it compulsory disposal cost. Remember, see, they have given you here. Let me shift the page first. Listen, this is year 0. This is year 25, just for your example. And at the beginning of the contract, we came to know that when we'll end this power plant, we need to decommission it. Listen very carefully. So, and the cost of decommissioning is $1,000. For example, just for your example, the cost of decommissioning at the end of year 25 is $1,000. So what we do, first of all, we calculate the present value. So let us say, as the gap is very much, it's 25 years. So present value came out to be $400. Listen very carefully. This is all basic accounting, please. $400. So you know what you do with how you make this entry? You capitalize it. You write PPE. Okay. PPE debit and provision credit. Okay. Now listen, just think, let us say on the same day, not in future, on the same day, somebody told you that now you don't need to decommission after 25 years. Somebody told you you don't need to decommission after 25 years. Now you need to decommission it after 8 years, just 8 years. Now you need to decommission it after 8 years, and same decommissioning cost will be used. You don't need to decommission it after 25. Now earlier in 8 years. So now just think, now we have to pay the same amount after 8 years. Can you calculate the present value? Can you calculate? The distance is shorter now. You better know financial management a little bit. So when the distance is shorter now, and now you will calculate the present value. So this present value will be, let us say, $600. This present value will be more. Now it will be more. You can try it using 25 years and then using 8 years, your present value will be higher. So now what does it means? It means your existing number was 400, but now suddenly the whole decommissioning cost increases. So what you will do with this extra 200? See, you will make the same entry. You will increase your PPE by 200 and you will increase the provision by 200. Okay. You will increase the PPE by 200 and you will increase the provision by 200. So at one end, you will increase your PPE. On the other hand, you will increase your provision. At one end, you will increase your PPE, and the other hand, you will increase your provision. Two things. And now, as the life has reduced, as I said earlier, as the life has reduced, so now you will earn less, only 8 years you will earn, not 25 years. So now, yes, you need to do impairment testing for that asset. Okay, only this PP thing, only PP thing, assets. We do impairment testing for assets. Okay, impairment testing for assets. Now you need to do impairment testing for asset. Okay, so this is the treatment. This is the treatment of, wait, let me write the, check the requirement. Discuss how the following should be accounted for in the financial statement: the destruction of non-current assets and decommissioning of power plant. Another 4 marks. Another 4 marks. Believe me, this is all, this whatever I've discussed, this is the solution. This is, obviously you need to write in theory, but this is the solution. This is the solution. Okay, first of all, what I said, just write off the 250. The write off the 250, no need to do any impairment testing because the asset is destroyed. For that, remember, the manufacturing facility destroyed, zero, nothing will come out. So no value in use and no fair value less cost to sell. Okay, P&L debit and asset credit. And second thing, I discussed this decommissioning liability thing. Decommissioning liability thing with the revision of useful life. With the revision of useful life. Okay, now just think 1 minute about all these things. 1 minute, take 1 minute or 2 minutes. Wait. Now you have two more interesting issues. You have two more interesting, three more interesting issues. Listen. This is again the combination of IS 37 and IFRS, IS 37 and IS 20 government grant, IS 37 and IS 20 government grant, basic standard. But yes, listen, Collard company has in the past repaired minor environmental damage that it has caused, but it has never suffered a natural disaster on this scale. Listen, yes, as we are operating, definitely we may create pollution. So then if we are creating pollution, listen to me very carefully, so we are damaging the environment. So in past we repaired minor, word C, repaired minor environmental damages. So this minor damage can't create a valid expectation. Can't create a valid expectation. I'm talking about constructive obligation. Constructive obligation, I'm sure you guys know this. Okay. But this event, this type of natural disaster, this is the first time event. So no past history of such event with us. Okay. So no more constructive obligation now. There is no legal obligation for Collard Company to repair and restore the damage caused by the disaster, as this will be the responsibility of the government. That's it. That's it. That's it. 3 lines, enough. Just discussed IS 37. You remember in IS 37, we only make provision when there is a present obligation. When there is a present obligation, and you know, present obligation are 2 types. One is constructive and one is legal. One is legal and one is constructive. There is no legal obligation. You can read it clearly from the question. And the constructive obligation only arises when our past practices or our act or our announcement creates valid expectation to those affected, right? So my dear student, we have no such past practices. There's just a word minor. No such past practices. Listen. And plus, this is the first time of natural disaster. So definitely no past practice possible, not possible. This is the first time of the disaster. So no legal obligation as well as no constructive obligation, because we haven't done any announcement. We don't have any past practices, or we don't communicate through our act. So in this first paragraph, we are not responsible for anything. So no provision is required. No provision is required. Are you getting? Now listen. The government announced on 1st December X7 that there would be compensation of 50 million available to repair the environmental damage only, and that the companies should apply for the compensation by December X7. By 1st March X8, when the financial statements were approved, Collard Company had only received acknowledgement, see the wordings, of their application, but no approval. The real thing is approval. The real thing is approval. The real thing is approval. Wait, now, wait. Simple IS 20. You know, IS 20 says you can recognize grant in your books when 2 conditions are satisfied. Very famous dialogue, very famous. When 2 conditions are satisfied. IS 20 says, I repeat, you can recognize the government grant. You can recognize the government grant when 2 conditions are satisfied. Number one, when you have reasonable assurance, when you have reasonable assurance that you will fulfill conditions attached in the grant. Okay, and number 2, that the grant will be received. Will. I sometimes, because I teach junior students as well, I teach financial reporting of all levels. So when students study this standard first time, so how do I explain these 2 points? Listen, in the first point, IS says to check yourself. Reasonable assurance that you will fulfill all the conditions attached in the grant. Whatever conditions are attached in the grant, there are high probabilities that we will fulfill. So auditor will check us. In point number 1. And the point number 2, that the grant will be received. That means the government authorities has also approved. The government authorities has also approved or issued a letter to us. Yes, we will give you grant. So the day we'll receive this confirmation, the day we'll receive this approval or confirmation, then we'll make the entry. Then we'll make the entry grant receivable debit, grant receivable debit, and P&L credit. Grant receivable debit and P&L credit. Grant receivable debit and P&L credit. Now some intelligent students may ask, sir, when we studied this standard, when we studied this standard, we made the entry deferred income. We credit the entry deferred income. Yes, even I taught you deferred income. Listen, the reason is deferred income we do when you have to carry on with that asset on the remaining useful life. This time you are getting for the past act, you are getting this grant for the past act, and which you have already done. The loss has, the damage has already been done, the damage has already been booked in the P&L. Remember, the damage has already been booked in the P&L. So when the damage has already been booked in the P&L, so this thing will also go in the P&L to match. This thing will also go in the P&L in the match. Remember, the major concept is matching principle. So these are the two driving factors. These are the two driving conditions of IS 20. If you want to recognize grant, you must fulfill these two. Now, students, my questions to all of you, one question. Do you think we have satisfied these two conditions by the year end? We haven't satisfied the second condition. We haven't satisfied the second condition. That's why we can't book this grant. That's why we can't book this grant. One student is asking why credit P&L. If whenever we make the entry in this question, we'll make grant receivable debit and P&L credit on the date of approval. Why P&L credit? Because we are getting this grant for the losses which has already been done, and which has been gone in P&L. We are getting this grant from the past for the past act. So now we don't need to do anything. To fulfill this grant. That's why P&L. So see this requirement, please. I just discussed this part. Point number 2, the cost of repairing the environmental damage. I just discussed, and the potential receipt of government compensation. Yes, somebody is asking if it was approved before the authorization of financial statement, before the signing off. Yes, this will be an adjusting event because at the year end the condition exists. We applied before the year end. Yes. Now, one of my favorite, and I always give lectures for this thing, hedging. Listen, and this issue I have taught in my class. In my recordings, this issue is available. Yes. In my notes, this issue is available. Yes. In my PDF files, this issue is available. Discontinuation of hedge accounting. Believe me, I've taught this. They are asking only one case. I taught 2 cases in class. In reality, there are 2 cases. And one more interesting thing, even in your Kaplan study text, this case is written. This is the last thing I'm going to teach you today. Last thing. Hedge of commodity price risk in aluminium. Collard Company hedges commodity price risk in aluminium, and such transactions were classified as highly probable in accordance with IFRS 9 financial instruments. However, the purchases which were considered highly probable prior to the natural disasters are no longer expected to occur, First of all, can you tell me which hedge is this for highly probable forecast transaction? Which hedge accounting we do? Fair value hedge accounting or cash flow? Very good. Excellent. Excellent. Cash flow hedge. Yes. For highly probable forecast transaction, we do cash flow hedge accounting. For highly probable forecast transaction, we do cash flow hedge accounting. We do cash flow hedge accounting. We do cash flow hedge accounting. For highly probable forecast transaction, we do cash flow hedge accounting. Okay. Now, you have read this, now. Yes, excellent. Some students have given me the solution even, but I'll explain you, don't worry. Listen, I'm using a separate proper page to explain this. Listen. You know, in cash flow hedge, for highly probable forecast transaction. First, let me revise. We are here right now. This is month 0, and we plan to buy a machine. After 6 months. And this is highly probable. That we'll buy this machine. Listen very carefully. This is the last thing. Now I'll end the class. Last thing I'm teaching you. That's it. We have planned that we are going to buy this machine after 6 months. Okay. But the issue is that our currency is, let us say, pounds. Our currency is pound, but this machine we have to buy from United States, so it will be dollar based. So just see the difference in currencies. So there is an exchange rate risk. Yes, we have a risk. First thing, yes, we have a risk. So now, to mitigate this risk, to reduce this risk, we entered in hedging instrument now. Okay, we entered in hedging instrument now. A derivative. We entered in a forward market bet or a derivative now. And now listen, why did we enter in this hedging instrument? All of you listen. Why did we enter in this hedging instrument? To reduce the risk of this hedge item. Which will come in future. That hedge item which will come in future. Remember? Okay. So now in this particular cash flow hedge case, the hedge item will come in future. Right now we have only hedging instrument. Okay. So now whatever fair value change, in hedging instrument, we will book in OCI. Or let me say the proper word, the effective portion. Now you are no more kids. The effective portion of this fair value changes of hedging instrument will be booked in OCI. Why OCI? Because the purpose of hedge accounting is matching. And we have entered in this hedging instrument to protect that hedge item. And that hedge item will come in future. So the day that hedge item will come, the day that highly probable forecast transaction will occur, then we'll transfer this OCI into PNL. Then in future, we'll transfer this OCI into PNL. Okay. That's why all hedging instrument, all effective portion of fair value change of hedging instrument will go in OCI now. Okay. Now listen. As we have planned to buy this machine, this was highly probable thing. Okay, listen, just use, let's assume the case of this question. We have planned to buy this highly probable forecast transaction, and we entered in hedging instrument before. So till this date, till this date, we booked $50 gain, $50 gain in OCI, $50 gain in OCI, and that $50 is basically fair value change, fair value gain of hedging instrument. Okay, but suddenly the disaster happened here. The disaster happened here, and now because of this disaster, we are crying. We have changed all our plans. Now we have openly told everybody that we are not going to buy this machine anymore. We are not going to buy this machine anymore. So just think, students, now this highly probable forecast transaction is not expected to occur. So there is nothing to match in future. Use your brain. There is nothing to match in future. So now what you will do, you will transfer this OCI into P&L immediately. You will transfer, let us say this is a gain OCI. So you will make the entry OCI debit now 50 and P&L credit. You will transfer this OCI into P&L now. And what's the logic? Because nothing to match in future. Did you understand, all of you? Did you understand? If you have studied normal lecture, definitely this is your second time for this topic. Students, did you understand? In this 4 marks, listen. In this 4 marks, you need to write that first of all, this is the cash flow hedge. This is the cash flow hedge thing. This is the cash flow hedge thing. Okay. And highly probable forecast transaction, this is the introduction you need to write. And for cash flow hedge thing, as the hedged item, listen to me, all of you, hedged item will come in future. So the effective portion, effective gain or loss of hedging instrument is reported in OCI, because we need to match in future. Now in the second line, you will write the application of this thing as listen to me, as this highly probable forecast transaction is no longer expected to occur. That's why all the previous OCI gain or loss of hedging instrument will be transferred to P&L immediately. And if you want to write the logic, you can write this, because nothing to match in future. That's it. Be relevant. Okay. So now students, now listen, students, the purpose of hedge accounting is offsetting. Listen, this is also one very famous dialogue. The purpose of hedge, listen, the purpose of hedging is to reduce risk, no doubt. But hedge accounting, listen my words, hedge accounting is all about matching and offsetting. Hedge accounting is all about matching and offsetting, same period, same statement, same period, same statement. When I teach, I say these lines many times. Hedge accounting is all about matching, offsetting, same period, same statement. Okay. Now listen, students, for current issue, read all the latest articles, plus on my YouTube channel, I have posted latest current issues already. You can see. Even I'll send the link. Send the link on the group. Okay, so you can watch it. Okay, and keep sending the questions. Those who are registered students, they can send you the scripts to me. I'll mark them, and please do try to do practice on software. Try to write it, so that, and try to solve in the last week, especially in the last 3 days. Try to solve complete past paper in one go. Sit in a separate room, and try to solve the complete past paper, because some students said in previous attempt that we were not able to complete the paper even. We were not able, time management issues. So better do a recce, better do a demo practice. Okay, so in this way you will have a third or fourth time in the exam to solve the paper, right? You can do it and try to attempt complete 100 marks in the exam. This is the best advice I would give. Complete 100 marks, go for complete 100 marks. Okay, and try to go for easy marks first. Easy marks first. You have seen, see, I have solved the latest past paper with you guys. I have solved the latest past paper with you guys, and you have seen there are some easy scoring marks in this paper as well. So in each and every paper, these easy marks are there. These easy marks are there, and these easy marks will make you clear, okay? Even you can see the results of last attempt. Students scored 70, 65, 67. So obviously they are also human being. They are, and even they also studied last month. One thing I would like to tell you, the lady who scored Pakistan top in the last attempt, in that is June 2021 attempt. I still remember that was June attempt. He started studying on 28th April. I have the message saved in my phone. She told me that now I want to start properly studying. Will I be able to clear? I said yes. 1 month is enough. 1 month, 28th April to 5th June or 10th June, like that. So when she can got position in 1 month, why can't you clear? Normal human being. Why can't you clear? You can clear. So be positive, think good, and stay in touch. We'll send you more resources. Okay. Take care. Thank you.